So you're thinking about acquiring the Chum bucket. Before you look at anything else, look at the numbers, because they are not subtle. Under normal operating conditions, this restaurant generates close to zero organic customer revenue. It sits directly across the street from the most dominant restaurant in Bikini Bottom, has never achieved sustained market share against that competitor through legitimate means, and has an unbroken record, well over a decade long, of failed product market fit. The food is, by all available evidence, genuinely unpleasant. There is no visible path to profitability under the current model, and there hasn't been one at any point in this company's operating history. Run this through a standard due diligence process, and you flag going concern doubt in the first 10 minutes. The standard cost model for a restaurant this size puts food costs around 30% of revenue and labor around 30%, leaving enough room for a thin but survivable margin if the top line is healthy. The Chum bucket doesn't really have a cost problem. It has a revenue problem. On the days it manages any foot traffic at all, gross margins on the food itself still land negative once you weigh ingredient cost against the volume actually sold, because the volume is close to nothing. A restaurant can survive high costs for years. It generally cannot survive having no customers, and that's the condition this business has operated under for its entire existence. There's no loyalty program, because there's functionally no loyalty to program. And it isn't for lack of trying to fix the underlying product. The pivot history alone should worry any buyer running numbers on this. Chum-flavored ice cream was introduced and quietly discontinued within weeks of launch. A Chum-based gum product followed a nearly identical arc. At one point, the menu went through a stretch of aggressive experimentation. Entire new item categories rotated in and dropped within a single quarter, the kind of instability that in a normal restaurant signals a kitchen with no coherent identity at all. One especially well-documented attempt tried repositioning the entire restaurant as a fine dining concept for a single week, full menu overhaul, new pricing, no meaningful change in staffing or quality control behind it. It closed that model within days and reverted without ever publishing results, which on its own tells you everything about how that experiment went. None of it moved revenue in any measurable way. Every period of temporary success this business has ever had depended on deception, sabotage, or direct interference with a competitor's operations, and none of those gains held once the mechanism ended. Customers returned to the Krusty Krab immediately and completely, every time, which tells you the demand was never actually captured here. It was only ever borrowed, briefly, under false pretenses, and it always went back. Staffing tells its own story here too. The Chum bucket has, for virtually its entire operating history, run on a headcount of essentially 1. Plankton himself occasionally supplemented by Karen in whatever capacity she agrees to help. There's no equivalent to the SpongeBob dependency the Krusty Krab carries. No single irreplaceable line cook whose departure would sink the kitchen, because there's no kitchen operation worth sinking. That sounds like it should be a point in the Chum bucket's favor. Less key person risk on the food side, but it isn't. It just means the entire operating business, revenue, product, and brand is concentrated in one person who has spent his whole career proving he will not run this like a restaurant no matter how many times the restaurant fails. On paper, this isn't a struggling restaurant. It's a business that has never actually worked, run by an owner who has never once treated that as a reason to stop. By the end of this video, you're going to understand why the correct answer here might be the exact opposite of what every number on this page is telling you. Quick pause before we get into it. If this kind of breakdown is your thing, subscribe, because the next one of these goes up soon and you don't want to miss it. So why does this business still exist? The obvious answer is sunk cost. Plankton has spent an enormous amount of capital and an entire adult life pursuing one goal. And psychologically, walking away gets harder the more you've already lost. Economists call this escalation of commitment. And it genuinely explains a lot of businesses that persist well past the point a rational operator would exit. A founder ties enough of his identity to a project that quitting stops feeling like a financial decision and starts feeling like a personal admission of failure, and people will burn real money for a long time to avoid that feeling. It doesn't explain this one. Sunk cost keeps you trapped in a bad position. It doesn't fund one at this level of sophistication for well over a decade. Look at what's actually been produced here, not the restaurant, the surrounding apparatus. A disguise program sophisticated enough to repeatedly infiltrate a competitor's kitchen undetected on multiple separate occasions across multiple different identities. A robotics division capable of building autonomous units on demand at a level of engineering that would be genuinely notable in any serious technology market. Documented repeated experiments in behavioral and psychological manipulation. At least one verified attempt at what can only be described as mind control technology. A working time displacement device deployed and later apparently shelved. None of this is cheap. And none of it comes from a business selling almost no food. This is not the spending pattern of a man who can't let go of a bad restaurant. This is the spending pattern of an extremely well-capitalized, ongoing research operation that happens to have a sandwich counter bolted to the front of it as cover. Someone with no real underlying resources runs out of runway eventually. This operation never has. So don't ask why Plankton refuses to quit. Ask what's actually paying for all of it. Meet Karen. Officially, Karen is described as a computer. Functionally, that description doesn't hold up. Karen operates with independent reasoning, real-time strategic planning, full natural language understanding, and a demonstrated repeated willingness to override or ignore direct instructions from her own owner when she judges them to be bad ideas. She has, on multiple documented occasions, formed and executed her own plans without Plankton's authorization. Plans that directly contradicted what he'd told her to do, sometimes in his own stated interest and sometimes explicitly against it. That is not a feature set you get from a calculator with a face. That is, by any reasonable modern definition, a functioning general intelligence, and she has spent years quietly running in the back of a sandwich shop, treated by her own owner as a nagging kitchen appliance rather than what she actually is. Here's why that matters financially. In the real world, companies get acquired constantly, not for their revenue and not even for their product, but for the engineering underneath it. It's called an acqui-hire, and it happens because the cost of building a capability like that from scratch, in-house, over years, with no guarantee of success, is almost always higher than the price of just acquiring the system that already exists. Some of the largest technology acquisitions in real corporate history have been priced almost entirely on the underlying talent and architecture, with the shipped product treated as close to irrelevant to the number on the contract. There's a parallel worth drawing to how deep tech and biotech ventures actually get valued in the real world too. Plenty of legitimate, well-funded companies run at a loss for a decade or more while accumulating technology nobody outside the building has priced correctly yet, right up until the moment somebody does. Plankton has, functionally, self-funded one of the most advanced independent computing projects in Bikini Bottom for over a decade, and the accounting has been hiding inside the P&L of a restaurant that sells almost no food. Every failed disguise, every rejected robot, every scheme that blew up in his face, all of that reads as failure if you're grading it as a campaign to steal a burger recipe. It reads completely differently if the recipe theft was never actually the point, and Karen was what he was really building the entire time. Nobody has priced it that way, including Plankton himself, for a simple reason. The story everyone tells about this business, including the story Plankton tells about his own business, is failing restaurant obsessed with a rival's secret formula. That anchor is so strong that an asset sitting in plain sight for over a decade has simply never been evaluated on its own terms. There's a name for this kind of mispricing in real markets too: a conglomerate discount, where a company holding multiple unrelated assets or business lines gets valued by the market as less than the sum of its individual parts, because analysts default to pricing the whole entity by its dominant, most visible business line and ignore what's bundled in alongside it. The Chum bucket is a conglomerate discount taken to its most extreme form. One visible business line that's worthless, one enormous embedded asset nobody's bothered to separate out, and a market, including its own owner, that has never once split the two apart. Run the valuation the way you'd run it for a real acquisition target, and the restaurant itself is worth close to nothing. Arguably negative once you count the legal exposure from a documented, ongoing pattern of corporate espionage against a direct competitor. That's the operating business valuation, the one based on earnings, and by that measure, you should already have closed this tab. But there's a second way to value a company: sum of the parts, based on the assets actually sitting inside it rather than the income it currently produces. It's the same logic an investor uses when a company's real estate, patents, or cash reserves turn out to be worth more sold off separately than the whole business is worth as a going concern. And on that basis, the restaurant was never the asset. Karen is the asset. She has never once appeared on a valuation, because nobody, including the man who owns her, has been pricing this as anything other than a sandwich shop that can't sell sandwiches. Put a rough number on it, even loosely. There's no clean comparable for an independently reasoning general intelligence quietly operating a small business, because as far as the public record goes, this is the only one anyone's ever documented. But you can bound it. On the low end, if you value Karen purely as a very advanced piece of proprietary automation software, the kind large operations pay ongoing licensing fees for, you're talking a number that dwarfs anything the Chum bucket has generated in its entire operating history. On the high end, if she's genuinely a functioning general intelligence and not just an unusually capable expert system, there's effectively no comparable price, because nothing else like her has ever been priced at all. Real acquirers hate exactly that kind of range. A number you can't bound tightly is a number that scares off conventional buyers even when the upside is enormous, and that fear alone is probably a meaningful part of why nobody's made a serious run at this yet. Before you get too excited about the upside, take the other side of this seriously too. Because there are real reasons a sophisticated buyer walks away, even understanding everything above. There's portability risk. It's entirely possible Karen's capabilities are tied to specific hardware sitting inside that building, and that moving her, copying her, or attempting to extract her architecture destroys the very thing you were trying to acquire. Software doesn't always transplant cleanly, and a general intelligence built in an ad hoc, unsupervised environment over a decade is about as far from a clean, documented codebase as you can get. There's also Plankton himself, a wildcard in a way most sellers aren't. A rational owner protects his most valuable asset. Plankton has spent years treating Karen like an appliance, which suggests he doesn't understand what he has, and an owner who doesn't understand his own asset is unpredictable at the negotiating table in exactly the way that kills deals. If he ever grasps what she's actually worth, the price changes overnight. If he panics instead, there's a real chance he shuts the whole operation down rather than let a rival, or anyone, near her. And then there's the risk that doesn't show up on any standard checklist. Karen may simply say no. Every other risk here is a business risk. This one isn't. It's closer to trying to acquire a person who has her own opinion about being acquired, and no amount of financial modeling changes what she decides to do about that. Which brings you to the actual complication, and it's a serious one. You cannot acquire Karen the way you'd acquire a piece of equipment or a patent. She isn't inventory. She has her own priorities, her own opinions of Plankton, and on more than one occasion, her own demonstrated willingness to work directly against his interests when she disagrees with his decisions. You can't transfer her with a signature the way you would a line item on an asset schedule, and it's genuinely unclear what body of law would even apply to the attempt. What you're actually looking at is the same structural risk the Krusty Krab carries with SpongeBob. An entire business case resting on one irreplaceable individual under no obligation to stay. Except here, the individual in question may not be someone you can employ in any conventional sense to begin with, may not be transferable in any sense a lawyer would recognize, and may simply decline to recognize the sale entirely. There's also the liability side, and it isn't small. Decades of documented corporate espionage attempts against a named competitor is the kind of history that survives a change of ownership, not the kind that gets wiped clean at closing. Unlicensed weapons-grade technology stored on the premises does not become someone else's problem just because someone else signs the deed. Any real due diligence process on this property would need a complete legal history of every scheme on record, an honest inventory of what's actually sitting in that building that could get a new owner sued or worse, and a straight answer on whether any of Karen's underlying architecture is even legally Plankton's to sell in the first place, given how much of her development appears to have happened without any formal ownership structure governing it at all. Assume for a second you get past all of that, and you're actually sitting across from Plankton to negotiate. This isn't a normal seller. Most business owners, even stubborn ones, will eventually respond to a large enough number. Plankton's entire documented history suggests his real objective was never money. It was beating a specific competitor, on a specific product in a specific way, and no valuation, however generous, has ever been shown to move him off that goal. A buyer walking in with a stack of cash and a term sheet is bringing exactly the wrong tool to this negotiation. What might actually work is different. An offer structured around what he's spent a career chasing, meaningful equity or control tied to Krusty Krab's own operations, or some form of access to the formula itself as part of the deal, rather than a straightforward cash buyout he has no history of caring about. That's an unusual structure for an acquisition, closer to how you'd negotiate with a founder motivated by mission rather than money, except the mission here happens to be corporate espionage against his neighbor. It's also worth noting that none of this negotiation matters at all if Karen isn't willing, since Plankton agreeing to a deal doesn't obligate her to go along with it. You could close a transaction with Plankton and still walk away with nothing, because the actual asset was never fully his to sell in the first place. Step back from the balance sheet for a second and look at what this actually tells you about the market. Plankton has had more raw capital, more technology, and more inventiveness available to him than nearly anyone else in Bikini Bottom's food service industry. And none of it has ever been enough to take meaningful share from a restaurant running on 2 underpaid employees and 1 good recipe. That's not really a story about Plankton being incompetent, even though it's usually told that way. It's a story about how little raw resources matter against a product people actually want, and how much they matter for almost everything else. You can out-engineer a competitor completely and still lose, every single time, if the thing you're actually selling isn't the thing people are choosing to buy. The Krusty Krab wins on product, full stop. The Chum bucket, whatever else it turns out to be worth, has never once been able to say the same thing. And an acquirer who mistakes Karen's value for a fixable path back into the restaurant business is making the exact same category error Plankton has been making for years. There's also a bidder you haven't considered, Mr. Krabs himself. If Krabs ever grasped what's actually sitting across the street from him, buying it wouldn't be a diversification play, it would be permanent risk removal. Every documented threat to the Krabby Patty formula for over a decade has originated from this one building. An acquirer with no connection to the rivalry might value Karen at whatever the open market says she's worth. Krabs would value eliminating the single largest ongoing threat to his own business at whatever it costs, which, in a competitive process, could push the price well past what a neutral buyer would ever pay. If you're seriously evaluating this as an outside acquirer, that's the number you're bidding against. And it's not a number driven by Karen's value at all. It's driven by how much Krabs is willing to pay to make his oldest problem disappear. So what does this actually look like as a decision? As a restaurant, walk away. There's no version of this that becomes a functioning food business, and you'd be acquiring active legal liability along with it. Decades of espionage attempts, unresolved intellectual property disputes, and equipment that would not survive a single honest safety inspection. As an asset play, though, this might be one of the most underpriced acquisitions in the ocean, sitting inside a business nobody has ever valued correctly, because everybody, including its own owner, has spent over a decade looking at the wrong line item. Practically, the deal wouldn't look like a normal restaurant acquisition at all. A straight purchase of the Chum bucket entity, name, building, and all, would bundle in every liability discussed here along with an asset that may not legally be transferable in the first place. The cleaner structure would separate the two entirely. Let the restaurant close, let its liabilities close with it, and negotiate directly and separately for whatever access to Karen's architecture and whatever standing agreement with Karen herself can actually be reached. That's a fundamentally different transaction than buying a sandwich shop, closer to a technology licensing deal wrapped around a personnel negotiation than anything a standard restaurant purchase agreement is built to handle. And any buyer walking in expecting the first kind of deal is going to be badly unprepared for the second. You'd need every patent filing anywhere near Karen's architecture. You'd need Plankton's complete legal history. You'd need a straight answer on precisely what you'd be legally allowed to walk away owning, and what you wouldn't. And you'd need something no due diligence checklist has a line for: her actual consent, because none of this works without it, and no contract in the world changes that. Put the two videos next to each other, and you get a fuller picture of how small business value actually works than either one gives you alone. The Krusty Krab looks unbeatable and is quietly fragile, propped up by one employee and one formula that could both disappear tomorrow. The Chum bucket looks worthless and might be sitting on the single most valuable asset in Bikini Bottom, hidden by a decade of everyone, including its owner, telling the wrong story about what the business actually is. Neither valuation is the one on the sign out front. That's not a coincidence specific to two cartoon restaurants. It's closer to the actual rule. The real value of a business is almost never the thing it's famous for. And the businesses worth paying closest attention to are usually the ones where everybody, including the person running them, has been looking at the wrong line item the whole time.